Hello everyone, welcome back to my channel. I'm so happy to be sharing my passion with you all. I'm glad you guys are liking the videos. One of the biggest feedback I've gotten on my videos and on my channel is they people struggle to understand exactly what I'm talking about. And that's more of a reflection on me as a teacher here than it is on you. Because what I should have done is I should have started with the foundation, with the basics. And that's what this video is going to be. We're gonna do a deeper dive on the portfolio theory foundations. Right? It's gonna be heavier on theory. We're gonna dive into some examples, some empirical examples as well. But this is gonna be heavier on the theory side. So if you're interested in that, you're gonna love this video. And another thing I want to mention is that in my previous two videos, I didn't really have a script or anything. I just kind of said whatever was on my mind. I just had a couple pictures on a Google slide. Here, I think it's important for me to provide a little more structure. So I do have some notes here, and I'm also going to have some bullet points here on the slides that I'm going to read off of. Let me know what you guys think of that. I'm still experimenting with how I want to make these videos. I don't want to just be reading off a script. That's just not how I am. But I felt like for this video, it was important for me to impose a little more structure because we want to get the foundations right? So why don't we get started? So how are financial assets priced here? So the price of a financial asset is going to be the present value of its future cash flows. So we calculate this by taking the future income an asset is expected to generate, like a bond's coupons or a stock's free cash flow at equity, and we adjust it to today's value using what's called a discount rate. So the discount rate here is critical, right? It's critical because what we're doing is, so the discount rate, it includes a risk-free rate of return, which is for the time value of money, and then we have a risk premium to compensate you for risk taking. And essentially, higher risk means a higher discount rate and therefore a lower current asset price, while lower risk results in a higher current asset price but also lower returns. Right? Basically, it's how expensive an asset's cash flow is. That's what we care about here when we're buying an asset. So the two main drivers of returns, I talked a bit about risk. We need to be compensated for bearing risk. But another way people make money in financial markets is through what we call arbitrage or mispricing, right? I think a stock is worth $100. Right now it's currently trading at $50. So I can buy it for $50, and then eventually when the market corrects itself and the stock is at $100, I just made $50. I just made 100% on my money, right? And that's a very basic example. I'm just trying to give you a basic example of how people capitalize on mispricing. This is a topic for another video. Right now, I'm going to focus on risk-based models here. And I'm not saying mispricing is wrong, and we could get to that. That's a whole other nuanced topic. For today, I want to focus more on risk-based. So one thing we need to understand is not all risks are the same, right? People will look at examples like Nvidia or like Apple and say, well, this stock is very risky. The asset's very volatile. Therefore, I should have a higher expected return on that asset. And really, what we need to decouple is the idiosyncratic variance from the systemic variance, right? It could be true that these assets have high systemic variance, causing it to have a higher return, higher expected return. But if an asset has high idiosyncratic variance, it doesn't really bear any relation to an asset's return. Basically, if your portfolio is heavily concentrated, you have that idiosyncratic variance, and you're not compensated for bearing that risk. And why is that? Because idiosyncratic risk is easily diversifiable. And we're going to get more into that later in the video about systemic risks, how we identify those risks, and who should be loading up on those risks. So we're going to talk about this handsome gentleman over here. This is Eugene Fama, right? And in the 70s, he formalized this theory. It's referred to as the efficient markets hypothesis. And basically, what the efficient markets hypothesis is a market that is pricing in all relevant information. And a lot of people, this is a controversial theory, right? But really, basically, some of the key assumptions here, that alpha generation is not possible, markets react quickly to new information, and risk and return are strongly correlated, right? And this is controversial because basically this model calls into question the efficacy of the active management industry. And again, this is a topic for a whole other video. I'm not going to bore you with the details right now. But I want to talk more about the different types of market efficiency, because even Eugene Fama, the guy who made the hypothesis, does not believe markets are perfectly efficient. So there are three types of efficiency here. We got the weak form efficiency. Basically, today's prices are a reflection of yesterday's prices, and simple trading rules like technical analysis is not applicable in generating alpha. But fundamental analysis might be able to generate alpha, like researching a company and making sure that it's fairly priced, or if it's not fairly priced, that might be able to generate alpha in a weak form efficient market. Semi-strong form basically postulates that fundamental analysis and technical analysis might not work at generating alpha, but the one thing that might generate alpha is private information that's not available to the public. And then strong form efficiency is basically the idea that even if you have insider information, you will not be able to profit. And that's the efficient markets in its extreme form. Not many people believe in strong form. Most people believe it's somewhere in between semi-strong form and weak form, right? But I want to talk about some problems with efficient markets. First of all, it's just a model. It's not a perfect reflection of reality. It's not intended to be a perfect reflection of reality. And really, I think people should just take it for what it is. Try to learn from it. Don't use it as a law. It's not law. Markets aren't perfectly efficient. Even Eugene Fama doesn't say that. It is a model that helps you think about your portfolios and helps you think about how you should be trading. It's not a perfect reflection of reality. I don't think it should be intended to be that way. Another issue with efficient markets is that it can't be definitively proven. And this is due to the joint hypothesis problem that I've talked a lot about it in this channel. Basically, it's the idea that any test of market efficiency is going to jointly be a test on the asset pricing model being used. And to give you an example, I've often talked about the CAPM and skewness, right? So if there's been a bunch of studies out there basically demonstrating that investors do not like the left tail of the return distribution. They don't like negatively skewed assets with negatively skewed return distributions, right? I think that's intuitive. But under a CAPM model, that we're going to talk about CAPM later on, but under that asset pricing model, a negatively skewed return distribution would generate alpha. And alpha could mean one of two things. It could mean I was skilled. I was a skilled selector of stocks, which generated performance in excess of what could be explained by the mean variance framework. Or I just took more risk that our model wasn't being picking up on. And that's the issue with market efficiency is that it could just be, if a model is wrong, it could be indication that our model is not picking up on that risk, not the fact that the model is, or that the markets are not efficient. Does that make sense? I hope that makes sense. The final nail in the coffin for efficient markets is the Grossman-Stiglitz paradox. It is a paradox. Market efficiency is a paradox. Markets could never be perfectly efficient. And why is that? The reason why markets are efficient is because active managers have an incentive. They're able to profit from mispriced assets. But if no asset is mispriced, there are no active managers in the market. The profitable incentive for them to bring information to the market has disappeared. And if there's no managers in the market, then market prices no longer reflect current information. It's paradoxical. So, again, that's why Eugene Fama himself, the guy who formalized the hypothesis, does not think markets are perfectly efficient. And in my opinion, again, people read into this too much. I think the main lesson you should learn from efficient markets is that markets are forward looking. Markets are forward looking, okay? So I have an example for you here. Basically, I want to talk about Kelly Manila. It's a simple example to illustrate the importance of looking at forward looking information, right? So basically, the insights from Kelly Manila and intermediary asset pricing is that financial intermediaries act as the marginal investors in a variety of complex asset classes like stocks, sovereign bonds, corporate bonds, options, commodities, etc. Right? And basically, their capacity to take on risk is constrained, typically by regulatory and economic equity capital ratios. And when this ratio unexpectedly drops, they're forced to simultaneously sell assets across markets, driving down prices, increasing their expected returns, which is that risk premium we're talking about, for assets most exposed to this constraint. And here, Kelly Manila proxy for intermediary wealth using the intermediary's market equity plus their divided by the market equity plus their book debt, right? That's the ratio. And I want to show you what happens when we take this ratio. That's how they proxy for intermediary wealth, right? So this is the wealth of intermediaries, the current wealth of intermediaries. You would expect it when their wealth goes up, the market price of the stocks any asset goes up. When the wealth goes down, the market price of the asset goes down. Correct? That's what we'd expect. But what I'm going to do here is I have their data right here. So this first column here is just the ratio, the base ratio. So I'm going to run this script. It's going to, it's taking a minute. Sorry about that. I don't know why it's taking so long. There we go. I'm going to run this first column. It's just the ratio. That's the intermediary wealth. And we're going to run a regression. And here we get a regression output. And here, we see we have very low relationship here. Let me move my camera down so you can see. We have a basically non-existent relationship here, right? The relationship is non-existent. We look at the regression, the relationship is non-existent. So why did I just talk about intermediary wealth for a while if there's no relationship? Well, this is just looking at the ratio. This is looking at the ratio at a point in time, right? But we can't just look at the headline ratio. We have to look at shocks to the ratio, unexpected changes to the ratio, right? And that's where we use what's called the AR1 model, an autoregressive model, right? And what we do here is we're basically regressing the model on the ratio on itself. So we're regressing the ratio at time t on the ratio at a time t minus 1. So we're basically omitting one variable. We're lagging this by 1. And then we regress it. So we're basically seeing how much of the ratio today is explained by the ratio yesterday. And this error term, this right here is an error term that I've labeled ICF. What does ICF mean? ICF is an intermediary capital factor. That is how we're constructing the factor, right? And what that does is it isolates all the changes in intermediary capital ratio that isn't explained by the previous intermediary capital ratio, the ratio the day before. So I already have that set up, the IC shock. So if we go here, we run the script again. And now this time we run the IC shock. And then we generate that regression output. And you see, it was a very necessary change. Now our relationship is much stronger. And this is intuitive. Again, let me move my face. This is intuitive because markets are forward-looking. We need to isolate what markets are already expected. We need to isolate the unexpected shocks. Two changes in the intermediary capital ratio. And that's something that permeates all of financial markets. As you read more and more and more about financial markets, they're going to compare it to survey data, or they're going to compare it to, they're going to run AR1 models or ARMA11 models, right? To try to extract the residuals from those autoregressive models to get the unexplained variation in changes to the variable you're analyzing. You can't just look at the headline variable, because that incorporates expectations, which, if everything materializes as expected, then there shouldn't be any change in the market price. We always got to compare the market implied expectation to what we believe our expectations to be in order to be a successful stock trader or analyze these trends here. So let's go back to my slide here, and let's move on to this handsome fella. This is Harry Markowitz, and basically he formalized the mean variance framework, otherwise known as modern portfolio theory. So this is the idea that investors, they don't like risk, but they're willing to accept it as higher returns. And here he uses volatility as the main proxy for risk here. And diversification, it allows you to lower your volatility by loading up on assets with a low covariance with one another. And on the assumption that investors are mean variance optimizers and that markets are efficient, the market portfolio is the mean variance optimal portfolio. And I don't mean to throw a lot of jargon at you. I know that might sound a little confusing. But remember what an efficient market is. It's a market that is pricing in all relevant information. Investors that want to optimize, they want the highest mean return and the lowest variance. The investors who are trying to do that, that means the market of all tradable assets is going to trend to the optimal portfolio, which would be the maximum return, minimum variance. I hope that makes sense. And then, so basically, under this theory, everyone should own the market portfolio, but you cater to your risk preference through a long position in the risk-free asset. Basically, you're lowering return, but also lowering risk, or a short position in the risk-free asset, otherwise known as leverage. You're basically able to borrow at the risk-free rate and buy more of the market portfolio to increase your returns in proportional to the amount of risk. So here I want to talk now about CAPM. This is going to be the most basic asset pricing model, right? So basically, this is intended to be a testable prediction of the mean variance framework. It builds on the idea that investors are mean variance optimizers. It basically describes the relationship between an asset's expected return and its risk relative to the market premium. The market is generally proxied by total stock and bond ETFs. Oftentimes, I see a lot of people use the S&P 500. I prefer to use the total global equity markets. But sometimes people include bonds. Again, that's a topic for another video, what we should be using. But what you need to know is a beta of 1 means that the asset or portfolio moves roughly in tandem with the market. A beta less than 1 means it's less sensitive to movements in the market. And a beta more than 1 means that a portfolio or asset is more sensitive to movements in the market. And the CAPM here is going to explain roughly 2/3 of the variation in all diversified portfolios. It's pretty good. It's pretty good at explaining portfolio returns. But as you can see, that it's not perfect. There's still that 1/3, which is huge. And here I have an example for you. Again, let me move my head. So suppose your portfolio has a beta 1.3, the market has a return of 8%, and the risk-free asset is 2%. What is the expected return on this portfolio? And I'll give you a second to do the math, and I have the answer here on the next slide. So the answer is 10.22%. Let's walk through this. Beta here, 1.37. We have this market risk premium here, so it's 8% minus 2%. So it's 6% here times 1.37. That's going to be 8.22 plus the risk-free rate of 2%, 10.22%. Just basic algebra, nothing too complicated. Now it gets exciting. Now we're going to talk about this handsome fellow. His name is Robert C. Merton. He is a legend in the finance space. He's someone who greatly influenced me and how I approach investing. So he developed what's called the intertemporal capital asset pricing model. Basically, the main difference between this model and the CAPM is that the CAPM is a single period model. It basically assumes that investors make their decisions to maximize utility derived from their terminal wealth, mean and the variance, at a fixed single horizon, treating the future investment opportunity set as certain or irrelevant, right? But the ICAPM is a multi-period or intertemporal model that recognizes that investors make a series of decisions over time and care about how their current choices affect not just their final wealth, but also their consumption and reinvestment opportunities, or otherwise known as their state variables. I'm going to call them their state variables, right? And they care about this across all future periods. And this multi-period view is why hedging against future risks become important, right? So basically, the main takeaway from ICAPM is that there are variables beyond mean and variance that people care about. They care about how their portfolios can vary with other variables like their labor income or their consumption needs or nature of investment opportunities, foreign investor treatment, inflation, recessions. And the way I like to explain this topic, because people get confused, they look at like volatility metrics and they that's more tangible. You could look at it, you could see it. But it's not just about interim volatility. It's not just about cross asset correlations. The principles of diversification do not stop at cross asset correlations, right? And I think that's intuitive. It's harder, it's more abstract, and it's harder to visualize. I understand. But I do not think the principles of diversification stop at cross asset correlations. They extend beyond to your state variable sensitivity. And we're going to get more into examples later. Actually, I have an example for you right here. So the market portfolio here is no longer mean variance optimal under this model, right? What it is, it's multi-factor efficient. It's balancing all of the risks, not just mean and variation. It's not just balancing mean and variation, all of the risks beyond mean and variance. So we, like I mentioned, labor income, recession risk, inflation risk, every risk that's not being captured by mean and variance, right? And under efficient markets, this is optimal for the average investor. The market portfolio is optimal for the average investor. But it's not mean variance optimal, it's optimally balancing all the risks. And we'll get more into that later. So this is one example. I'm borrowing from John Cochran's paper, Portfolio Investing in a Multi-Factor World. This is the example he gave that I use all the time, right? So if we consider one additional factor, let's call it a recession factor. Now, investors care about not just the mean and variance of their portfolio, they care about three factors, right? They want the highest average return, the lowest standard deviation, but they're willing to accept a portfolio with a little less return or a little higher standard deviation if the portfolio doesn't do as bad in recessions. And I think that's intuitive, right? You're sacrificing a bit of standard deviation, you're sacrificing a bit of return, but you get a portfolio that when a recession happens, it doesn't do as poorly. And this intuitively follows that less demand for stocks that do poorly in recessions results in lower asset prices, all else being equal, thus higher asset returns. I think that's intuitive. I really do. ICAPM is controversial in my circles. I really don't know why. I think it's very intuitive. And then we delve into modern portfolio theory, right? If mean variance model is modern portfolio theory, I would call this modern portfolio theory, right? So as I mentioned, the market portfolio is multi-factor efficient. Per efficient markets hypothesis, the market portfolio is optimally balancing the risks to be maximally diversified for the average investor. But who is the average investor? the average investor, and this is where another place, this is another controversial thing, which I don't think it should be. The average investor is a dollar weight of all market participants. So that includes, and it's going to be disproportionately, and again, we talked a bit about intermediary asset pricing. Intermediaries dominate the dollar weighted average, right? So that's one example. That's one example. We have to analyze intermediary constraints and compare it to our constraints. We have different constraints than intermediaries. So using ICAPM logic, ICAPM theory, we know that we have different constraints than those intermediaries. So we want to analyze what risk do they not want to take that we can take, and vice versa. What risk can we not take that they can take? And then who should be hedging recession risk? That example I just gave you. Who should be taking recession risk? Well, we should look at how you're exposed to that risk relative to that average investor, right? So I want you to think of financial markets as a sort of big insurance market here. Trades can be justified by investor heterogeneity, right? I just talked about intermediaries. They have different risk preferences. They have different asset preferences. For example, they have to have in large proportion high quality liquid assets, right? We don't have the same constraints as them. We could load up on more illiquid assets like tips, and I'm going to give you an example here. So financial markets, they might be zero sum in a financial sense, meaning that in financial markets, if you win more than the market, someone else had to lose. And that's how it works. It's zero sum in a financial sense. But when we measure it in a utility sense, we've both gained from the interaction. If I want to hedge recession risk, I take lower returns, but my portfolio is better in a recession. So my utility is increased the same way when I buy car insurance, the insurer gets my money and I lose money. It's zero sum interaction in a financial sense. But in a utility sense, I've gained in that when I crash my car, knock on wood, when I crash my car, I get the money exactly when I needed it. And that's beneficial to me from a utility, from a satisfaction, from an economic standpoint. And I hope that makes sense. It's the same here with financial markets and hedging. When I want to hedge recession risk, yeah, I'm losing financially. I'm losing my mean return. But I could also be an insurance seller and I could gain financially. I can gain return. And it's just a matter of whether you want to be an insurance seller or an insurance buyer. And here, this entire process, it facilitates an efficient risk transfer. Basically, you get the risk premium if you want to be the seller. And you are the the insurance buyer. You're losing out that opportunity cost of being able to get that return. And here's a real world example, and you guys are going to recognize this if you watched my DWK video. But I talked about this. Here is a replication of the Cederberg life cycle research. Basically, they use a block bootstrap model and determine a couple's utility of consumption and bequest at the end of the lifetime utility of consumption and bequest, right? Based on various allocations. And here you see, despite the massive dispersion in stock returns, it produced the highest utility of consumption and bequest, right? And why is that? Because stocks exhibited mean reversion in real terms, while bonds and bills exhibited mean aversion in real terms, meaning that periods of poor periods of poor bond returns were followed by periods of even more poor bond returns. And that's driven by inflation, right? And here we get an inflation risk premium. So we could be an inflation insurance seller, but what do we get out of that? We get only 1 or 2 basis points? We get a couple of basis points from being an inflation risk seller? We know that the inflation risk is such a big deal for us, and all we get in return is a measly 2 basis points. So that's where I think ICAPM is so important. Here we're recognizing that due to heterogeneous asset preferences, we know that households are bearing such big risk in inflation risk, and we know that the reward for being an inflation risk seller, right? We're selling the insurance is dirt cheap. Like, we're barely getting anything out of it by being a seller, and we're taking this massive risk. And that's where ICAPM comes into play, right? That's why we should be inflation buyers in this case. We hedge our inflation, and it costs us next to nothing for doing so. That is an intuitive example of ICAPM, right? And that's pretty much it. That's how I approach investing. It's heavily based on ICAPM theory. In the next video, maybe I'll talk about mispricing and statistical arbitrage. And yeah, I hope you guys understand. Maybe you guys could watch some of my other videos. Maybe you guys could extract some more information out of it. I think that would be great. Thanks, guys.